The IRS just changed the rules for 2026 retirement. And if you don't know about these changes, you could be leaving thousands of dollars on the table. We're talking up to $24,000 in deductions for individuals and nearly $47,000 for couples. That's $47,000. But here's what nobody's telling you. These deductions phase out, and there are hidden traps that could actually cost you more money than you save. I recently had a client, a 72-year-old retired teacher, who thought he had everything figured out. He knew about the $6,000 bonus. He was excited, but he made one critical error, and it cost him over $4,000 and triggered a Medicare penalty that's still costing him $300 every single month. What did he do wrong? I'm going to reveal his exact mistake in about 6 minutes. Write down this timestamp if you need to 6 minutes from now, because I guarantee some of you are making the same error right now without even knowing it. Stay with me, because I'm breaking down the exact numbers you need to know before tax season kicks off on January 26th. That's just days away. And more importantly, I'm going to show you exactly how to avoid the catastrophic mistake that's costing retirees thousands every single year. Hey everyone, welcome back to the channel. Tell me in the comment what your age is and where you are watching from. For those of you who are new here, I break down complex tax and financial topics into actionable strategies you can actually use. No jargon, no fluff, just real money-saving information. And today's topic, this could be the difference between keeping thousands in your pocket or handing it back to the IRS. The One Big Beautiful Bill Act has completely changed the game for seniors in 2026. Most people assume taxes go down in retirement, but with these new brackets and deductions, the rules have completely flipped. Here's the truth. Nobody talks about this, but financial stress in retirement rarely comes from market returns. It comes from misunderstanding taxes, income planning, and timing. One wrong move, one missed form, one poorly timed distribution, and you can lose thousands without even realizing it until it's too late. So, if you're 65 or older, or if you're planning for retirement in the next few years, or if you have aging parents who need this information, you're in exactly the right place. Let's dive into the exact numbers the IRS just released. These aren't projections or estimates. These are the official numbers published by the IRS for tax year 2025, which you'll be filing in 2026. But before we get into the numbers, let me tell you about Robert, the client I mentioned. 72 years old, retired teacher, solid pension, good Social Security, the kind of guy who does his homework and plans ahead. Robert wasn't careless. He wasn't ignoring his finances. In fact, he was the opposite. He was being proactive, trying to optimize his retirement strategy. In 2024, Robert did something his financial advisor recommended. It wasn't a bad move on paper. It made perfect sense. He was trying to be smart with his retirement money. He'd read about the benefits of Roth conversions. He'd attended seminars. He'd done his research. So when his advisor suggested converting a substantial amount from his traditional IRA to a Roth, he thought he was making a brilliant move. Fast forward to 2026. Robert opens his Medicare statement and nearly falls out of his chair. His monthly premium had jumped from $174 to almost $480. That's an extra $300 every single month. $3,600 a year just gone. And here's the worst part. Nobody told him it was preventable. Nobody told him about the one form he could have filed to stop it. Nobody explained the 2-year look-back rule that would come back to haunt him. What did Robert do? I'm going to tell you his exact mistake in just a few minutes. But first, you need to understand these new deductions, because that's where his problem started. And trust me, once you see what he did wrong, you'll understand why I'm so passionate about getting this information out there. This isn't theoretical. This is happening to real people right now. It could be happening to you or someone you love without you even knowing it. Let's start with the big news, what I'm calling the senior bonus. And trust me, this is actually good news. First, here are the new baseline standard deductions for 2026. Look at your screen now as I go through these. These are the foundation numbers that every taxpayer gets regardless of age. Single filers get $1,600 to $100. That's $1,600 to $100. This is up from $15,000 in 2025. So we're seeing inflation adjustments that actually help taxpayers for once. Married filing jointly gets $32,200. That's double the single amount, as it should be. Head of household gets $24,150. This filing status is for single parents or those supporting dependents. Write those down if you need to. These are up from previous years, but here's where it gets really interesting, and this is where most people miss out on thousands. These baseline numbers are just the starting point. If you're a senior, there are layers upon layers of additional deductions that stack on top of these numbers. And most people, even tax professionals, don't fully understand how they all work together. Now, are you 65 or older, or will you turn 65 by December 31st, 2025? If yes, the next 60 seconds could put thousands of extra dollars in your pocket. And I'm not exaggerating. This is literally money that the IRS is offering you, but you have to know it exists and you have to claim it correctly. There's a brand new senior bonus deduction if you're 65 or older by the end of 2025. That's the tax year we're filing for in 2026. You get an extra $6,000 deduction, $6,000. That's not a tax credit where you get the full amount back. It's a deduction, which reduces your taxable income. But still, depending on your tax bracket, that $6,000 deduction could save you anywhere from $1,200 to $2,400 in actual taxes. And if both spouses are 65 or older, that's $12,000 straight off your taxable income. $12,000. Imagine if someone walked up to you and said, hey, I'm going to make $12,000 of your income completely tax-free. That's essentially what's happening here. But wait, and this is where it gets powerful. This isn't the only deduction seniors get. This new bonus actually stacks on top of other deductions you already qualified for. We're not talking about choosing one or the other. We're talking about layering these deductions on top of each other to create a massive shield against taxation. Let me show you how this all adds up. Look at the screen right now because these numbers stack up fast, and I promise you're going to want to screenshot this. Here's where this gets powerful. I call this your total shield against taxes. For a married couple where both spouses are 65 or older, here's what you get. And I want you to follow along with me because understanding this layering effect is crucial. First layer, standard deduction for married filing jointly, $32,200. That's your foundation. Everyone who's married filing jointly gets this, regardless of age. This is the baseline we talked about earlier. Second layer, additional age deduction that's been around for years. This isn't new, but many people forget about it. $1,250 per qualifying spouse. So if both of you are 65 or older, that's $3,300 total. This has existed for decades, but it often gets overlooked because it's relatively small compared to other numbers we're dealing with. Third layer, the new senior bonus deduction, $6,000 per person, so $12,000 total. This is the game changer. This is what makes 2026 different from previous years. This is what makes it worth paying attention right now. Now add it all up with me, $32,200 plus $3,300 plus $12,000 equals $47,500. That's nearly $50,000 of your income that's completely protected from federal taxes. Think about that for a second. If you're a married couple bringing in $90,000 a year in retirement, $47,500 of it is completely tax-free. You're only paying taxes on about $42,500. Let me put this in perspective. The median household income in America is around $75,000. For retirees, it's often less. So for many couples watching this video right now, you could be paying taxes on less than half your income. That's a massive advantage. That changes your entire financial picture in retirement. If you're single and 65 or older, here's your stack. And while it's less than what married couples get, it's still substantial. Standard deduction, $1,600. Everyone gets this baseline. Additional age deduction, $2,050. This is higher than the married amount per person because you're filing as a single taxpayer. New senior bonus, $6,000. This is the same as what married couples get per person. Total shield, $24,150. If you're single and living on $50,000 a year, less than half of it is even taxable. You're only paying federal income tax on about $26,000. For someone on a fixed income, maybe with just Social Security and a small pension. This could mean the difference between scraping by and living comfortably. This is real money we're talking about. But before you get too excited, I need to tell you about the trap. This is critical, and this is where we start connecting back to Robert's story. Now, here's where thousands of dollars can disappear if you're not paying attention. And this is exactly what started Robert's problems. Remember him? We're getting close to revealing what he did wrong. These bonuses phase out. If you make over $75,000 as a single filer or $150,000 as a couple, the IRS starts taking that bonus back. Here's exactly how it works. For every $1,000 you earn over the threshold, you lose $60 of the bonus deduction. Every $1,000 over equals $60 lost. This is called a phase-out, and it's designed to target the benefits toward middle-income seniors rather than high earners. The IRS does this with a lot of tax benefits, but understanding the exact mechanics is crucial for planning. And once you hit $175,000 as single or $250,000 filing jointly, the bonus is completely gone. Poof! You'll still get the standard deduction and the age deduction, but that powerful $6,000 or $12,000 bonus vanished. You're back to where people were before this legislation passed. Also important, you must file as single, head of household, surviving spouse, or married filing jointly. Married filing separately does not qualify. That's a hard rule. If you're married and thinking about filing separately for any reason, you need to run the numbers carefully because you could be losing this entire benefit. Let me show you how this phase-out works with a real example because this is where people get caught off guard and it's about to connect directly to Robert's mistake. Meet Jane. She's 67, single, doing well in retirement. Maybe she has a pension, some Social Security, and she took a little from her IRA this year. She's not rich, but she's comfortable. Here's her situation. Her total income, $80,000. The phase-out threshold, $75,000. She's over by $5,000. Now, remember the rule. For every $1,000 over the limit, you lose $60 of the bonus deduction. So Jane loses $5 times $60. That's $300 of her $6,000 bonus. You might be thinking, okay, $300, that's not the end of the world, right? I mean, she still gets $5,700 of the bonus deduction. She's still better off than if this benefit didn't exist at all. Wrong, and here's why, and this is crucial. That $300 reduction triggers what I call the domino effect. When your taxable income goes up by even a small amount, watch what happens. It can push you into a higher tax bracket. Let's say Jane was sitting right at the edge of the 12% bracket. That extra $300 of taxable income might push some of her income into the 22% bracket. It increases how much of your Social Security gets taxed. Up to 85% can be taxable, and the thresholds for Social Security taxation are surprisingly low. And here's the big one. It triggers higher Medicare premiums through something called IRMAA, Income-Related Monthly Adjustment Amount. This is the killer. This is what destroyed Robert's retirement budget. So that seemingly small $300 loss, it could actually cost you $1,000 or more when you add up all the cascading effects. This is exactly what happened to Robert, and I'm about to tell you the full story. But first, let me show you the flip side because understanding both sides of this equation is essential. Now, let me show you the flip side first because this proves that smart planning pays off. Jane's neighbor Margaret is also 67 and single, but Margaret's income is $73,000. She's under the threshold by $2,000. Margaret gets the full $6,000 bonus deduction, full amount, no phase out, no reduction, nothing. Same age, same situation, living next door to each other. But Margaret is going to pay significantly less in taxes simply because she managed her income strategically. Maybe she delayed a small IRA distribution until next year. Maybe she timed the sale of some stocks differently. Maybe she decided to hold off on that Roth conversion for one more year. Small moves, massive difference. And here's something that sounds backwards, but is absolutely true. Sometimes making $2,000 less in a given year can actually leave you with more money in your pocket after taxes and Medicare premiums. I know that sounds crazy. It seems counterintuitive. How can earning less money leave you with more? But the math doesn't lie. When you account for the phase out of the bonus deduction, the increase in taxable Social Security, and especially the IRMA surcharges on Medicare, you can absolutely end up worse off by crossing these thresholds. All right, we're at the 6-minute mark. Remember when I told you I'd reveal Robert's mistake right about now? Here it comes, and I want you to pay very close attention because this could save you thousands. This is the moment where everything connects. Now, let's talk about Social Security quickly because you need to understand this before I tell you what Robert did wrong. The rules for taxing Social Security haven't changed. Up to 85% of your benefits can be taxed depending on your income. Most people assume Social Security is tax-free. It's not. This is one of the biggest misconceptions in retirement planning. But here's the good news. In 2026, that new senior bonus actually acts as a protective shield. When you take that $6,000 or $12,000 bonus deduction, it lowers your taxable income. And lower taxable income means less of your Social Security gets taxed. This creates a virtuous cycle where the deduction protects more of your income from taxation. But remember, Jane, when she lost $300 of her bonus deduction because she was over the income limit, it didn't just increase her regular taxable income, it also increased how much of her Social Security became taxable. This is the washout effect. You lose the deduction, which increases your adjusted gross income, which increases the taxable portion of your Social Security, which increases your tax bill even more. It compounds. For married couples filing jointly, let me give you your complete picture one more time because this is the target you're trying to hit. Standard deduction, $32,200. Age deduction for both 65 plus $3,300. Senior bonus for both 65 plus $12,000. Total $7,500. That's a massive shield protecting your Social Security and other retirement income from taxes. But stay over $150,000 and you start losing it. Hit $250,000 and the bonus is gone entirely. Now, some of you watching this are thinking, this is great, but I'm already over those limits. Does this even matter to me? Yes, because there are strategies to manage your income. You can time your IRA distributions. You can use qualified charitable distributions. You can manage capital gains. But first, the trap that caught Robert, this is what you've been waiting for. This is the mistake that's costing him $300 every single month. All right, this is what happened to Robert. And if you've made any big financial moves in the last 2 years, you need to hear this. This next part is the trap that catches almost everyone off guard. It's called IRMA, Income-Related Monthly Adjustment Amount, and it can literally double your Medicare premiums overnight. This is what destroyed Robert's retirement budget. Robert retired in 2023. Great pension, solid Social Security, some savings. He was set. His financial picture looked excellent on paper. In 2024, he decided to do a Roth conversion. His financial advisor at the time told him it was a smart move, and honestly, it wasn't bad advice. Roth conversions can be brilliant for the right person at the right time. The theory is sound. You pay taxes now at today's rates, and then all future growth and withdrawals are tax-free. For someone in their early 70s with a long life expectancy, it can make sense. He converted $120,000 from his traditional IRA to a Roth. That's a substantial conversion. Tax-wise, he paid the bill that year. He wrote the check, thought everything was fine, case closed. That was his mistake. Fast forward to 2026, Robert gets his Medicare premium notice in the mail. He opens it and he nearly falls out of his chair. His monthly premium had jumped from $174, which is the standard Part B premium that most people pay, to almost $480. That's an extra $300 a month, $3,600 a year, just in Medicare premiums for the exact same coverage. Same doctors, same benefits, triple the cost. Now, you're probably wondering, how does a Roth conversion in 2024 affect Medicare premiums in 2026? Here's the trap. Medicare uses a 2-year look back to determine your premiums. That means for your 2026 Medicare premiums, the IRS is looking at your 2024 tax return 2 years ago. This is the IRMA calculation in action. Robert's Roth conversion in 2024 pushed his income way up that year. His adjusted gross income went from about $60,000 in a normal year to $180,000 because of the conversion. Even though his income in 2026 was back to normal, back to just his pension and Social Security around $60,000, Medicare didn't care. They saw that spike 2 years ago, and boom, ARMA surcharges. Now, here's the part that really frustrated Robert, and this is what makes me angry on behalf of clients like him. Nobody told him about Form SSA 44. This is the form you file to appeal your IRMA charges if you've had a life-changing event or income reduction. It's called the Medicare Income-Related Monthly Adjustment Amount Life-Changing Event Form. Robert could have filed this form, explained that the 2024 income was a one-time event from a Roth conversion, and potentially gotten those surcharges reduced or eliminated. But he didn't know about it. His advisor never mentioned it. The Medicare notice didn't explain it clearly, so he just paid the higher premiums for months, bleeding $300 monthly before someone finally told him. By the time he found out, he'd already paid over $2,000 in unnecessary premiums. Money that's gone forever. He can't get it back. So here's the lesson, and this is critical. Pay attention because this might apply to you right now. Did you sell a property in 2024? Convert a large IRA to Roth? Take a big distribution? Receive an inheritance that created taxable income? Sell a business, cash out stock options, receive a one-time bonus, realize substantial capital gains from investments? Even if your income is much lower now in 2026, you could be hit with IRMA surcharges that can add hundreds of dollars per month to your Medicare costs. And here's the kicker that most people don't realize. Most people just pay the bill without realizing they can appeal it. They think it's automatic. They think there's nothing they can do. They're wrong. If you're already retired, lost a spouse, or had a significant income reduction, you do not have to just accept these higher premiums. You need to file Form SSA 44 immediately. This form tells Social Security that your income has dropped, and they can lower your premiums retroactively. Retroactively means they'll give you back money for the months you overpaid. This is one of those things that can save you thousands of dollars a year, but most people have never heard of it. The Social Security Administration doesn't advertise it. Medicare doesn't promote it. You have to know to ask for it. After I told Robert about Form SSA 44, he filed it immediately. He provided documentation showing his 2024 Roth conversion was a one-time event. He included his 2023 and 2025 tax returns to prove his normal income level. He wrote a letter explaining the situation. Within 6 weeks, Medicare adjusted his premiums back down. He's now saving over $3,000 a year. That's $3,000 staying in his pocket instead of going to Medicare unnecessarily. And he got a retroactive refund for the months he'd already overpaid. The bottom line is this. That one-time income spike from 2 years ago could be costing you money right now, even though your current income is much lower. Check your Medicare premiums, look at your statements, and don't be afraid to appeal. The worst they can say is no. The best case, you save thousands of dollars. Now listen, we're about halfway through this video, and if you're still with me, that tells me you're serious about protecting your retirement money. The next few minutes are going to give you the exact action steps to make sure you don't make Robert's mistake. Stick with me because this is where we move from understanding the problem to solving it. All right, let's talk about the mechanics. Some of you are probably wondering, this sounds great, but how do I actually claim this senior bonus deduction? Good news, it's automatic. The IRS made this one easy. Unlike some tax benefits that require special forms or calculations, this one is built right into the standard tax return. You'll file using Form 1040 or Form 1040-SR, which is specifically designed for seniors. The SR version has larger print and slightly different layout, but the calculations are the same. When you fill out your tax return, you simply enter your date of birth. That's it. The form has boxes right at the top for this information. If you're 65 or older by December 31st, 2025, the IRS will automatically calculate your eligibility for both the age deduction and the new senior bonus. You don't need to write a letter. You don't need to provide proof. Your date of birth is all they need. If you're using tax software, TurboTax, H&R Block, Free Tax USA, or any reputable program, It should automatically flag your eligibility and apply all the deductions for you when you enter your birth date. The software does the math. You just need to make sure your birth date is correct. If you're filing a paper return, make sure you check the age 65 or older box. This is usually near the top of Form 1040. Don't skip this. Include accurate Social Security numbers for you and your spouse if filing jointly. And make sure your birth date is clearly written. A simple clerical error could cost you thousands. And remember, you don't need to itemize to get this deduction. This is a huge advantage. Whether you take the standard deduction or itemize, you still get this bonus if you're eligible. The deduction will reduce your taxable income, which means you'll either owe less in taxes or get a bigger refund. For most seniors, the new standard deduction amounts are so high that itemizing doesn't make sense anymore. You'd need to have more than $4,750 in itemizable expenses as a married couple or $24,150 as a single filer to beat the standard deduction. For most people, that's not realistic. Your mortgage interest, state taxes, and charitable donations would have to be enormous. Speaking of refunds, let's talk timing. Here's the timeline for getting your money. This matters because a lot of seniors are on tight budgets and they need to know when to expect funds. Paper filing, expect your refund in 6 to 8 weeks. That's the slowest option. The IRS has to manually process paper returns, and they're often backlogged. Electronic filing, you're looking at less than 3 weeks. This is much faster because the IRS computers can process returns automatically. Electronic filing with direct deposit, you could see your refund even faster, potentially within 10 to 14 days. This is the fastest possible method. Bottom line, file electronically with direct deposit if you want your money as quickly as possible. Why wait 2 months when you could have your money in 2 weeks? Set up direct deposit to your checking account. It's safe. It's secure, and it's dramatically faster than waiting for a paper check in the mail. Now, here's something really important you need to know, especially if you're watching from certain states. These federal deductions aren't automatically available in every state. According to the Associated Press, states have to decide whether they want to incorporate these federal tax cuts into their own state tax codes. Some states do this automatically. Their tax code is linked to the federal code, so when federal deductions change, state deductions change automatically. But other states require official action to implement the changes. Their legislatures have to vote, their governors have to sign. It's a whole process. So you'll want to check with your state's tax authority or a tax professional to confirm whether these deductions apply to your state taxes as well. Here's how to find out. Google your State Department of Revenue 2026 tax changes. Most states have websites with updated information. Call your state's tax helpline. They can tell you directly. Ask your tax preparer specifically about this. Don't assume, verify, because you might get the federal deduction but not the state deduction, which means you're still paying state taxes on that income. For people in high-tax states like California, New York, or New Jersey, this could make a substantial difference in your overall tax bill. All right, we're coming into the home stretch. The next 4 minutes are your action plan. If you only remember 4 things from this entire video, make it these 4 steps. This is what separates people who save thousands from people who overpay. The 2026 tax changes are here, and proactive planning is no longer optional. This is the difference between keeping your savings and handing them back to the IRS. Let me give you your 4-step action plan. I want you to actually do these things, not just nod along. Number 1, audit your income. Stay under those senior bonus limits if possible. If you're close to $75,000 as a single filer or $150,000 as a couple, you need to consider strategies to keep your income just below those thresholds. Every dollar over costs you $60 in deductions, plus all the cascading effects we talked about. Maybe delay an IRA distribution. If you don't need the money this year, wait until January. Maybe time your capital gains differently. Sell the stock next year instead of this year. Maybe hold off on selling that rental property until next year. The property will still be there. Here's a specific example. Let's say you're at $74,000 in income and you're thinking about selling some stock that would give you a $3,000 gain. Stop. Wait until January. Take that gain next year. Why? Because staying under that $75,000 threshold this year saves you way more than that $3,000 gain is worth. You keep your full $6,000 deduction, you avoid the domino effect on Social Security taxation, and you keep your Medicare premiums lower. That $3,000 you gave up, it actually saved you $5,000 or more in total tax impact. That's strategic thinking. That's playing chess instead of checkers. Number 2, diffuse the Medicare bomb. This is the Robert situation. Check your 2-year look back right now. Pull out your 2024 tax return. Look at your adjusted gross income. Now compare it to your current 2026 income. If there's a big drop, anything over $20,000 or $30,000, file Form SSA 44 to lower your Medicare premiums. Where do you get Form SSA 44? Google it. Form SSA 44 PDF. Print it, fill it out, mail it in, or take it to your local Social Security office. This alone could save you thousands. Remember, Robert, after filing Form SSA 44, providing documentation showing his 2024 Roth conversion was a one-time event, he got his premiums adjusted. He's now saving over $3,000 a year. That's real money. That's a vacation. That's a new roof. That's peace of mind. Number 3, maximize your deductions. Whether you itemize or take the standard deduction, make sure you're getting every dollar you're entitled to. And here's something most people don't think about. If you're close to the itemizing threshold, you can bunch your deductions. What does that mean? Instead of making charitable donations every year, make 2 years worth of donations in 1 year. Same with medical expenses. If you can control the timing, bunch them. This way, you itemize in the high deduction year and take the standard deduction plus your senior bonus in the other year. You're playing the game strategically instead of just letting it happen to you. Number 4, use income shifting strategies. Look into these tools, Roth conversions during lower income years, but do them smart. Don't do what Robert did and convert a huge amount in 1 year without thinking about Medicare implications. Spread it out over multiple years. Convert just enough to stay under the thresholds, maybe $30,000 or $40,000 per year instead of $120,000 all at once. Qualified charitable distributions or QCDs. If you're over 70 and a half and you donate to charity, you can send money directly from your IRA to the charity. It doesn't count as income. It satisfies your required minimum distribution, and it keeps your AGI lower. This is one of the most powerful tools for seniors who are charitably inclined. Donor-advised funds. These let you make a big charitable contribution in 1 year. Get the deduction now, but spread out the actual donations over multiple years. The key is to be strategic. Don't just react. Plan ahead. Think about your income over 3 to 5 years, not just this year. And here's something I haven't mentioned yet that creates urgency. Tax season starts January 26th. That's just a few days away. But more importantly, if you're watching this and you're thinking about your 2025 tax strategy, you still have about 11 months before the year ends to make moves. This isn't just about filing your taxes correctly for 2025. It's about positioning yourself right now to maximize these deductions for 2026 and beyond. Check your income projections for 2025. Are you going to be over those thresholds? If so, what can you do between now and December 31st to get under them? That's the conversation you need to have with yourself or your tax advisor this week. Not next month, this week. Pull out your income sources, pension, Social Security, IRA distributions, rental income, investment income. Add them up. Where are you landing? Are you close to $75,000 or $150,000? If yes, you have decisions to make. Look, we've covered a lot in the last 20 minutes, but here's what it all comes down to. Taxes in retirement don't have to be complicated, but they do require attention. These new deductions could mean thousands of dollars staying in your pocket instead of going to the IRS, but only if you know about them and plan accordingly. If you found this video helpful, do me a favor. Smash that like button right now. Seriously, hit it. It helps more people find this information. And share this with any seniors in your life who need to know about these changes. Your parents, your neighbors, your friends from church, or the golf course. You could literally be saving someone thousands of dollars. I showed this information to Robert, my client, and it changed his entire retirement tax strategy. It could do the same for someone you know. If you haven't subscribed yet, hit that subscribe button and turn on notifications. I put out videos like this every week. Tax strategies, retirement planning, Social Security optimization. This is information that can make you money. Why wouldn't you want more of it? Drop a comment below if you have questions. I read every single one, and I